Executive Suite with WPRI.com reporter Ted Nisi.
Janet Yellen could soon be the most powerful woman in the world.
Thank you, Mr. President. I'm honored and humbled by the faith that you've placed in me.
She's President Obama's pick to lead the Federal Reserve.
She sounded the alarm early about the housing bubble, about excesses in the financial sector, and about the risks of a major recession.
Yellen has also been a vocal supporter of outgoing Chairman Ben Bernanke's push to boost the American economy by keeping interest rates low. And one of their intellectual allies is a local professor whose famous collaborators include Nobel Prize winner Paul Krugman of the New York Times. This week on Executive Suite, going behind the curtain at the nation's central bank with someone who knows it well, Brown University economics professor Gauti Eggertsson. Welcome to Executive Suite. I'm Ted Nisi. Gauti, professor, thank you for being here.
Thanks for having me.
And before we start, I know there are going to be some viewers who are a little worried. They're seeing a show about interest rates and monetary policy. It might not be the sexiest television we've ever done, but I don't think anyone who's gone through the last 5 years or so can miss just how important a role the Fed plays and monetary policy plays in the lives of all Americans. So I'm hoping, because you know it so well, we can kind of illuminate that for folks. Before we do that, though, I want to help people understand who you are. I know your name not from Brown, but from following the news about the Fed and how these policies are put together. But just so people know, you know Ben Bernanke personally. He's a real person to you, right?
Well, yeah. From the time he was a professor at Princeton, I mean, I was one of his students. So.
What was he like as a professor?
He was just, I guess, a classic bearded Ivy League professor, so very much like anyone else there in the halls of Princeton at the time.
Was it surprising to you to see him elevated and made one of the most famous people in the world?
I think that's fair to say, yeah, because I mean he was a very sort of regular, like any other professor there. He was not I mean, he stuck out for being extraordinarily smart, but there's a lot of other very smart people there as well. So it was a bit surprising to see how he got elevated.
And then I mentioned Paul Krugman at the top. Of course, he's known, a little controversial probably with our conservative viewers, as a liberal columnist for the New York Times, but he's another teacher of yours from Princeton. Is he as tough on his students as he can be on House Republicans?
No, actually, just like Bernanke, Ben Bernanke, he's kind to his students. he's another example of the classic bearded Ivy League professor. So, yeah, I guess they're sort of private persona was quite a bit different from, especially Paul's, to what we see on the news. So
let's start with, I want to get the most basic definitions simply out there for folks, as if you're teaching your 101 class maybe on macro. How do you define a recession, and then what is the Fed's role in dealing with that when it happens?
Well, I guess a recession is a classic example of what we have in front of us right now. So you see in the economy, certain segments of the population start cutting back on their spending, and that is not made up by somebody else. So firms seeing a reduction in the demand of their products start laying off workers. So we start seeing a lot of workers without jobs. And that's sort of the classic definition of a recession, where we have hosts of people that want jobs and can't find them. The role of the Fed typically in dealing with that is, so we see a cutback in spending of some parts of the population, and then we want to try to get other people to make up for that drop in spending. So what the Fed does is it cuts the nominal interest rate in order to try to get people to spend more, because as you have lower nominal interest rates, people see a reduction in their mortgages, it's become cheaper to buy cars, and that should stimulate spending.
So let's look at this downturn specifically. What do you think were the driving forces that caused such a severe crash? I mean, you've done a lot of research on this in 2008.
Well, I think one of the key aspects of it was this collapse in the financial market. So we saw a very sudden tightening of lending conditions, perhaps because people had overextended themselves a bit prior to the crisis. So suddenly you saw just a lot of people starting to cut down on their spending at the same time, those that were exposed to had done a lot of borrowing before. So it just became very hard for, I guess, the policymaker to get anything to step in instead of that drop in spending by certain players in the economy.
Just a lot of debt in the system all over the place.
A lot of debt in the system, and a lot of people that had overextended themselves that saw that they had to readjust pretty severely, and it was hard to make up for that.
So right now, and this goes to the core of some of your research, interest rates are basically at zero. And the Fed can't push them any lower because then we just keep cash under the mattress, right?
I'm not going to lend you $100 unless you give me at least $100 back. Otherwise, I would just stick it under the mattress.
Yeah, and then wait a couple years and hope for the best, which can be a vicious cycle. So that's led the Fed to engage in this thing known as quantitative easing. People who read their financial pages in the paper have probably seen some of that, QE1, QE2. But it's I think a little harder for people to get their heads around what the Fed is actually doing when it does quantitative easing versus it's easy to understand Alan Greenspan or Ben Bernanke, the rate was 4%, now it's 3.5%. What are they doing when we talk about quantitative easing?
So as you said, what the Federal Reserve has typically done is that it has just changed the short-term nominal interest rate, which is the interest rate banks borrow and lend from each other at. So the Fed has control over that, and when it tries to goose up the economy, it cuts that. As that goes down to zero, that is not an option anymore. So what did the Fed start to look at? It started to look at farther out. Even if the short-term nominal interest rate is zero, longer rates, I mean the rates we use when we buy a home or a car, they are not at zero. So the Fed started to try to affect those. How did it do it? It started basically, instead of buying short-term bonds, which was how they lowered the short-term nominal interest rate, they started buying long-term assets. So they started to buy mortgage-backed security, long-term government bonds. And the idea was then to try to lower those long rates, even if it couldn't affect the short rates because they were at zero. And that has been the goal of quantitative easing 1, 2, and 3, buying mortgage-backed security, buying long-term government bonds to try to affect long rates.
And another way policy the Fed can take based on, and they're doing this based on your research and another person who advised you, Michael Woodford, famous Columbia professor, is this idea of how the Fed talks and what the Fed tells us. Why is that important? And how does that matter? It seems silly, like what they say would affect the economy.
Well, but think about it for a second. The rate that, as you say, Greenspan was controlling and Ben Bernanke, is the short-term rate. That's the rate at which banks trade with each other overnight. Now, does that affect anybody's decision, what banks are trading with each other overnight? No. Presumably what matters for us is longer rates on, say, cars or mortgages and so on. Your
credit card, your mortgage.
Right.
Yeah.
Now, how are those rates determined? They are determined by what the banks expect those short rates to be, not just tomorrow, but going into the future. So they feed into those longer rates. So now the Fed can no longer lower that overnight rate. However, what it can do is to say how that's going to be in the future. And if it affects expectation about how that's going to be in the future, that can in exactly the same way affect the rates people pay on their mortgages, their car loans, and so on. So even if it's constrained at the overnight interest rate, talking about how that overnight interest rate is going to be in the future can have just the same effect. And that's precisely one of the things the Fed has been doing with forward guidance.
That's a powerful job when just your words can have a massive effect on the forecast for the economy.
And the key thing is then that people believe you. So that's why the credibility of the Fed is very important, that in fact people grow to assume that when the Fed speaks that you should pay attention and they're actually talking a fair game, that they're not.
People might remember Paul Volcker. Part of what I believe happened with him was that people suddenly said, oh, he's not kidding, he'll throw the economy into recession to keep rates down.
Exactly, so that's the key role of credibility here, except now it's going the other way. When Paul Volcker, he was trying to convince people that he would bring down inflation, was ready to raise rate as much as needed. Now we sort of have the opposite problem. The Fed is trying to convince people they're going to keep the nominal interest rate low for some time, for considerable time, until the economy finally picks up, because they're trying to affect the way in which people price longer-term assets like loans.
All right, we have to take a break. When we come back, we're going to talk more about the outlook for interest rates that affect all of us, and we're going to talk a little about Professor Eggertsson's home country of Iceland, which had its own experience in the financial crisis. Stick with us on Executive Suite. Welcome back to Executive Suite. I'm Ted Nisi, and we're joined this week, and it's a pleasure to have him by newly minted. He got there earlier this year, Brown University economics professor Gauti Eggertsson. His instructors at Princeton included Ben Bernanke, you might have heard of him, and Paul Krugman, and some others, and we're talking about the Fed and monetary policy and why it matters to you. So, Gauti, we talked in the first segment a lot about just how all this stuff works, and I appreciate your explanation on that. Now I'm just curious about your opinion on how it's gone. You know, we've been on 5 years of crisis response for Ben Bernanke and the Fed.
Right.
I mean, how would you rate the Fed's response, and how well do you think, are there things you would have done differently?
Right. I think to some extent it has gone very well. I mean, we haven't seen anything of the same order as, say, during the Great Depression in the U.S. So I think, particularly the initial phase, it was looking very, I think, scary for a while when Lehman went under, and there was, you know, the prospect of the whole banking system going on the side. So I think we prevented that. The disappointment, I suppose, is that the recovery has not been as fast as one would hope. I think the Fed has done a lot in order to try to facilitate. We talked about QE 1, 2, 3. It has implemented some forward guidance. I guess the question, should they do more? What is there more to be done? There, I think I would probably go to the recommendation of the then Professor Ben Bernanke that he gave to Japan in 2000. And what he told the Japanese government, or the BOJ in particular at that time, was that
BOJ being the Bank of Japan.
Bank of Japan, yes, sorry. Was that, okay, you have the nominal interest rate at 0, but what really matters here for spending is not really the nominal interest rate, which is the rate you pay on paper money, but the real interest rate, the difference between nominal interest rate and expected inflation. So you can lower that real interest rate simply by increasing inflation expectations. So he in particular recommended they would raise their inflation target some, and the Fed has not really gone very far in that direction, and could.
That's interesting. That's a question I had for you later, but I'll bring it up now then. Right now, the Fed targets about 2% inflation a year. Despite what some people might think based on certain prices in their lives, it's actually been below 2% throughout this period. But there's some, Ken Rogoff at Harvard, a well-known economist, have said maybe they should be targeting 5% or even 6% for a period and then go to a lower, but still higher than 2%, maybe 4% on a permanent basis. Sounds like you think that's at least worth exploring.
Yeah, at least a temporary tolerance for somewhat higher inflation would be beneficial. In the statement of the Fed, to be fair, I mean, they already say that they're going to keep the nominal interest rate at 0 until at least the unemployment rate is not below 6.5, or expected inflation is not 2 years ahead, is not much above, it's not above 2.5%. So, you know, they could just go perhaps a little bit further,
a little bit more aggressive on it.
Be willing to tolerate some more inflation to trade off inflation versus unemployment.
There are people who criticize these policies all over the place. And first I want to go to an argument, actually the one I think I hear the most often from sort of regular folks who don't follow economics quite as closely. But they think this policy punishes savers, people who are socking away money in a savings account. They're only getting maybe not even 1% a year on their account, and they think that's very little. What do you say to the idea that this is sort of harming savers to help spenders?
Well, I think a weak economy harms everybody, not only borrowers, but also savers, in terms of their income, in terms of the overall state of the economy. I don't think, so no, I'm not too sympathetic to that argument, I suppose.
Another criticism you hear, this is going to cause massive inflation down the road because the Fed's balance sheet has grown so much that at some point, somehow, all that money has to go somewhere, and therefore we're going to have a lot of inflation. We're just storing it up. What do you think of that?
I don't think that argument is very compelling. I mean, we saw, for example, Japan has had the situation we are facing now of 0 interest rate for about 15 years or so. They have seen their monetary base more than double, triple.
Monetary base being just the amount of money circulating in the economy.
Yeah, a lot of stuff there. So paper money plus, I guess, reserves that banks are holding at the Bank of Japan. Inflation has been below target for all that time. There's no science whatsoever that inflation, that's any uncontrollable inflation is just around the corner. Even there have been people predicting that for 15 years there.
In Japan,
yeah, they have just failed to be. In the same way, people have been predicting that for the last 5 years here too. If inflation becomes an issue, the Fed has a very straightforward tool to deal with it. Raise the nominal interest rate. And unlike now, when we are constrained by the fact we cannot cut it below 0, there's no constraint on raising it. So I'm not.
As we saw with Paul Volcker back
That's right.
in the 80s
That's
when
right.
that was an issue.
Yeah.
Do you think the Fed would do it? People sometimes worry what happened in the 70s where you got into a situation where you needed Paul Volcker to come in and inflation had gotten so high.
I have no doubt that there's enough will there. In fact, if anything, like I was suggesting, I think they should be a little bit more tolerant towards somewhat higher inflation, along what Bernanke said in 2000 to the bankers.
Just referring back to his own words. One other criticism that you hear, the idea this could be creating bubbles. Alan Greenspan's actually saying that all of a sudden as he goes on a book tour, that bubbles, the stock market's frothy, etc. What do you think of that idea, that the Fed, by keeping rates low, you end up building up the wrong parts of the economy?
I find it incredibly uncompelling. It reminds me a little bit of people shouting about the importance of flood insurance when the house is on fire. The problem right now is the fact that we have a lot of unemployed people, we have insufficient demand. This is not the right time to be worried about that, in my view. And I see very few and compelling evidence for any emerging bubble that we need to be concerned about at this time. I mean, down in the future that could be an issue. It also actually reminds me a little bit of what policymakers were saying in 1937 as the US economy was finally starting to recover from the Great Depression. They started talking about bubble, worried about froth, raised interest rate, and the economy collapsed again into the second phase of the Great Depression.
A double dip Roosevelt recession you hear
That's
about.
right. Yeah. And I'm concerned that I think it's just precisely the wrong thing to be worried about right now.
Finally, we're getting up toward a break, but I have a question more locally about Rhode Island. Obviously, you're looking at the world economy usually, not a little state economy, but how much do you think the economies of individual U.S. states like Rhode Island, how much is their path economically up to local policymakers, and how much are they just sort of being whipsawed by fiscal policy in Congress and the Fed policy and everything else?
I think if you compare, say, for example, to Europe, there's a lot of discussion, say, of the Greek crisis and so on, even if they also have a monetary union like we have here. The local economy has a smaller role than we see in Europe, simply because there's a lot more federal transfers in the US relative to Europe. Similarly, there is a lot of labor mobility across states, so I think then again that somewhat limits the importance of let's say, state government policy. However, having said that, I do think they do play an important role. And in particular, I think in this current crisis, it has been very counterproductive, the amount of spending cuts that has had to be done at local levels across the United States. And I think that has been one of the things that have created very, very serious headwinds for policy to deal with in particular.
And the Fed can only offset that so much.
Yeah, it's constrained, and it's not helpful then when across the U.S. individual states have had to really tighten their belts and cut their budgets.
All right, we're going to take a break. When we come back, we're going to talk about Professor Eggertsson's experience in the New York Fed as the economy was collapsing all around him on Wall Street. Stick with us on Executive Suite. Welcome back to Executive Suite. I'm Ted Nisi, and I'm joined today by Gauti Eggertsson, economics professor at Brown University, which he joined early this year after a number of years as a researcher at the New York Fed, the New York Federal Reserve, which Timothy Geithner ran before he became Treasury Secretary. I want to ask you about the woman we saw at the top, Janet Yellen, who's going to be the next head of the Federal Reserve. When you look at what you're hearing from the Fed and now her being picked, what do you expect in the next few years from Fed policy?
Well, I think she was very close to Ben Bernanke, so I think it's a continuation of the policies we have seen. So I'm not expecting a major shift one way or the other. So I think we're going to see a continuation of the policies.
So do you think we're looking at quite a few years of low interest rates in the U.S.?
I think that's fair to assume, at least into 2015 is my guess. Although, I mean, that when you make a forecast like that, that's just going to depend on the data that comes in. If inflation will start picking up, if unemployment goes down a lot, then that time schedule will change.
So it's if the economy stays this weak, you certainly expect low rates to continue.
And longer if it stays weaker for a longer period of time.
Because it's really being driven not by a time, but by the underlying health of the economy.
That's exactly right.
Yeah.
By the condition people observe.
And I mentioned you working at the Fed. I mean, I'm wondering, what was it like in those years, especially the fall of 2008 with the crisis? You were a researcher there. You guys were looking at what to do. I mean, what did it feel like inside the building as you watched, Lehman Brothers collapse and AIG going down?
I mean, for me, it was a particularly, let's say, traumatic event, because not only did we have the crisis in the U.S., my wife actually happened to have been working at Lehman Brothers at the time, went over. My country, Iceland, pretty much went bust.
So you saw it, really felt it.
So there was a lot of things going on. The Fed was a very busy place, obviously, at the time, because, I mean, one of the things that happened when Lehman went under is that I don't think anybody was expecting the cascading effect it did have almost immediately with AIG, and I think that caught everybody a little bit off guard.
Do you think that's because there was so much leverage in the system? Some people have said part of the problem there was when you're levered up, the impact is bigger.
I think that was part of it. I think that was part of it. Part of it was also that we hadn't seen such a big bankruptcy in U.S. history for a long time, so people really just didn't know what to expect.
Sure.
And, you know, under those conditions, it's sort of natural just to hold back. Everybody still is holding back. That's, you know, as it turned out that.
How worried were you personally? I mean, as you watched, especially that week when Lehman, as you said, Lehman collapsed, your country was in trouble, your wife is losing her job, and you're doing the research to try to fix it. I mean, you know, did you always have faith, Ben Bernanke and the others, they'll fix this, they'll get us stabilized, or, you know, what were you thinking?
Yeah, I think I was, I mean, I thought that it would, you know, work itself out. But, you know, of course, you had doubts from time to time. I mean, I had been doing research on these kind of crises for a long time, so I had pretty strong views at the time what should be done. But, you know, of course, you started wondering, maybe I missed something.
Yeah, yeah. I hope I got that equation right there that we're going to use today.
Yeah.
And you mentioned you're originally from Iceland. I mean, Iceland's banks basically collapsed. They had a lot of foreign money had come in, and it was it had built up the economy for a while there. And then Iceland actually decided not to pay off its foreign debts, to renege on that. You still talk to people I know from in that country where you're from. What's life like in Iceland now?
I think it actually, as it turned out, I think the crisis there was not as bad in terms of the effect. Of course, a lot of people lost a lot of money, and, you know, unemployment did go up. But compared to what I was expecting, I think things are not too bad. Unemployment is not too high there. The GDP is almost back to pre-crisis levels. So I think part of the secret to that success was, in fact, that they did let a large part of that banking system simply go bust. In particular, they split it into domestic and foreign part, and the foreign part went just into bankruptcy proceedings.
Yeah.
And yeah, so I think that helped.
And now you are here in Rhode Island. You joined the faculty of Brown University in January. What attracted you to Brown?
Well, it's a great university, of course, first of all, and then actually turns out my wife is from Newport, Rhode Island, so we have a lot of family here and love the state, so there's a lot of attractions.
Yeah, and how do you like teaching undergraduates?
I like it. I think the Brown students are great, and I'm having a good time talking about the crisis.
Have they protested you at all?
Not as of yet, but we'll see.
But the day
Give them time.
Finally, we only have about 30 seconds left, but I just want to ask, you know, how much do you think Congress cutting spending has impacted the pace of the recovery?
Oh, I think certainly it has had a very negative effect, and I think we would be in a lot better position right now if you hadn't had this contraction both at the federal and as we were talking about, the state levels too. If I would put a number on it, I'm not sure I would do that, but it's significant, I believe.
Yeah. So something to watch for in the coming years as the budget gets debated and everything.
Absolutely. I think that's going to be one of the key things looking forward, how that's going to resolve itself in Congress.
All right, Professor. Well, thank you so much for being here. It's all the time we have this week, but I want to thank Gauti Eggertsson for being here. You can find him at Brown University now, teaching you all about how the economy, what happens in the next crash. And Executive Suite will be back, of course, next week when our guests will be executives from Bank Rhode Island, talking about banking once again. Stick with us this week and every week on Executive Suite.